What's up, everyone? This is a chart of Bitcoin, and today we're going to be talking about something that I think is off of a lot of people's radars. So you can see that we have a interesting chart set up, and you can see we have 1, 2 red lines, and then we only have one single green line on the chart. And then we have these price range boxes set up. We have 2 red ones and a green one. So you're probably wondering what they mean. So this first red line, if you can see, was the very end of 2017, but it's actually supposed to represent January 1st. This is the closest date I could get. So on January 1st, this box starts, and you can see that if you were to sell when this box began, and you were to buy back in as you were going into this green box, you would have saved a 56% drop, and that's not even counting this huge sell-off capitulation move that we had back here. So probably considerably more than 56% that you just saved yourself, because you very well could have sold down here for quite a bit more of a loss. But let's just say you bought back in at this green box and then rode up until this red line that we have up here. You would have made over 800%. And you could see you pretty much captured that whole move that we just had in this Bitcoin bull market that we just had. And if you sold at this red line, you have, Bitcoin's been dropping pretty hard, so I drew that, I believe, last night. So you can see Bitcoin's selling off pretty hard, as we expected, if you've been watching our technical analysis over the last couple days. So if you sold there, you would have avoided a 40% loss. And this is actually where I took my profits. I didn't sell everything, and I am holding quite a bit, the majority of my portfolio, for the long term, and just collecting staking rewards and such. So, but I did take profits because of this event right here. And I'm looking back on it, I'm glad I did. Because now I have free cash available for when we do get our dip. I'm going to be able to buy in at very cheap prices, and I didn't really risk a whole lot if Bitcoin did go up to, say, 160K and took the rest of the crypto market with it, because I was holding the majority of my portfolio. So I'm happy with how this played out. But you might be wondering what these lines represent. And that's a very good question, and that's something that I become more and more interested with every day. And it's going to be the Supplementary Leverage Ratio. And I'm going to try to do the best job I can to make this as simple as possible, because in reality this is an extremely complex topic, because it deals with the plumbing of the economy, and it is part of the regulations of the banking system, and it was an addition to Basel III. So if the supplementary leverage ratio wasn't enough to try to understand, adding Basel III is going to make this a very complex video to try to understand, but I'm going to do the best job I can to put it in very simple terms and explain everything. And you won't need to look anything up, because we already did that. So any vocabulary, anything that I think is probably not mainstream knowledge, I did look up, and we do have definitions for that too. So by the end of this video, you will know something that I find personally very valuable. With that, let's get to it. So what is Basel III? So Basel III was started to be implemented before 2008. Or no, Basel II was before 2008, and Basel III, I believe, was 2009. But yeah, so this is the newest updated form of Basel, the Basel III. And this figure down here is probably the best one to look at just for a simple explanation. You can see issues addressed by capital floors and leverage ratios. So it basically tells you what problems this is designed to fix. And you can see there's two different variables that it's aiming to solve. So on this top section right here, you have 3, and on the bottom section, you have 3. So this top section, if you come over here, these are issues right in here that are addressed by the leverage ratio part of the Basel III. And these down here are addressed by the risk-weighted capital floor part of Basel III. So the ones that are addressed by the leverage ratio are use of low risk-weighted assets to boost financial leverage, unexpectedly large losses in low risk-weighted asset portfolios, lack of market confidence in risk-weighted assets. So the bottom one, again, is going to be issues that are addressed by risk-weighted capital floors. And these 3 issues are going to be risk-weighted asset inconsistency and dispersion, low level of models-based risk-weighted assets, and horizontal inequity in risk-weighted capital. So that probably sounds pretty confusing, and you really don't need to understand too much about the actual issues. Just more so that Basel III is aiming to really just implement capital floors and leverage ratios. So let's go over here. The Basel III Accord increased the minimum Basel III capital requirements for banks from 2% in Basel II to 4.5% of common equity as a percentage of the bank's risk-weighted assets. There is also an extra 2.5% buffer capital requirement that brings the total minimum requirement to 7% in order to be Basel compliant. And then down here, so actually I should have mentioned before, that was minimum capital requirements. And this down here is what is the leverage ratio and the actual percentages based with it. So I'll just read the whole thing. Basel III introduced a non-risk-based leverage ratio as a backstop to the risk-based capital requirements. Banks are required to hold a leverage ratio in excess of 3%, and a non-risk-based leverage ratio is calculated by dividing Tier 1 capital, which we will look at coming up here pretty soon, by the average total consolidated assets of a bank. And we won't do the calculations for this, but we will do the calculations for the SLR, or at least for the Tier 1 capital, and we'll use JP Morgan Chase as an example. We'll look at their balance sheet, and that won't take long, just a minute or two. But the Federal Reserve Bank of the United States fixed the leverage ratio at 5% for insured bank holding companies and 6% for systematically important financial institutions. All right, so they also decided to add the supplementary leverage ratio, and that's what this whole video is addressing, how the supplementary leverage ratio affects Bitcoin, because they really are kind of oppositions to each other, and you'll see that by the end of this video. So what is the supplementary leverage ratio? It was originally brought up, I believe, in 2012. Don't quote me on that, give or take a year or two. And was slowly brought along and was finally implemented mandatory compliance in 2018, as we saw from this red line over here. This was the first time SLR was in mandatory compliance. And this over here was in March of 2020, they exempted treasuries and reserves from the SLR ratio, or from the SLR calculations. So this whole period was when the SLR was actually in effect and doing what it was supposed to be doing. And then this period, they had exemptions to it. And then the exemptions expired on April 1st of 2021. And you can see as soon as they expired, things started to get pretty rocky for Bitcoin. Oops. All right, so the supplementary leverage ratio takes tier 1 capital and divides it by total leverage exposure. So that doesn't tell you a whole lot unless you understand what those mean. So let's look at tier 1 capital. Tier 1 capital is a bank's core capital and includes disclosed reserves that appear on a bank's financial statements. Tier 1 capital consists of shareholders' equity and retained earnings. So let's go over and look at JP Morgan Chase's balance sheet and see what that actually looks like. So to get the stockholders' equity, which we just were talking about over here, the simple way of breaking this down would be to take total assets and subtract total liabilities. And you can see that adds up to your stockholders' equity, which in reality is majorly retained earnings. All right. So what is total leverage exposure? Put as simply as possible, which isn't that simple, total leverage exposure is a regulator-defined quantity that measures a bank's total assets and a variety of off-balance sheet items, including derivatives, repurchase agreements, like the reverse repos, and a host of other items, including loan commitments, standby letters of credit, and trade finance exposures. All right, so this article, if you want to dig in the weeds and really get into the supplementary leverage ratio, this article right here does an outstanding job of explaining it. It's a little bit dated at this point. It was talking about back in March of 2021 about if they were actually going to extend the SLR ratio or the SLR, and they ended up letting it expire, but he lays out all the reasons why he thinks that it would be beneficial to at least exempt the reserves from the SLR ratio, if not treasuries also, like they did back in March of 2020. So what he says, and I agree, given the above, it is clear the SLR in its non-exempted form does not suit the practical nature of how the Fed relies on banks' primary dealers to operate monetary policy. So basically, this is a policy that is well intended, but doesn't necessarily fit with the way that we like to actually run and manage the economy. So why does it affect Bitcoin? If you notice, Basel III was updated after 2008. So it was pretty much a way of trying to avoid what was happening with 2008 and that whole crisis and not let it happen again in the future. And that's where the supplementary leverage ratio came in, is the Basel III did a really good job of monitoring on-balance sheet exposure, but it didn't really do a good job of monitoring off-balance sheet exposure. So that's why they implemented the SLR. So basically what they're trying to do is reduce the bank's ability to finance the government spending. And I don't know what a lot of people's aspirations in Bitcoin are. I think a lot of people are in the space these days. A lot of newbies are in the space strictly to get rich and just to see Bitcoin go to $1 million overnight. But personally, that's not why I like Bitcoin. I mean, I like it for that reason when it does happen. But personally, I like Bitcoin because I find it to be a hedge against a failing fiat system. And I think that's where we find ourselves today. So if the Fed and the government and the banks aren't allowed to run the money printer nonstop and devalue the dollar all the way to zero, with these rules in place, which is why these rules were implemented, that's a really good reason to end up buying Bitcoin, was because of all of the irresponsibility of our central planners. So if they are implementing rules that serve as a restraint to doing that, that is naturally in opposition to the bullish case for Bitcoin. So you can see how the SLR and Bitcoin both kind of oppose each other. But the thing is, the supplementary leverage ratio also restricts banks from purchasing too many treasuries. So as the Fed tapers and we start doing more stimulus and everyone wants to start adding supply to the treasury market or bonds or whatever it may be, everyone's going to be unloading their fixed income positions because real yields are so negative at this point. You have at least 5%, I would say, on at least the short end. As people unload fixed income, that means yields are going to go up, and no one can afford to pay higher yields, which means that at some point in the future, I believe that this is going to have to be altered once again. And I believe when that does happen, it'll probably mean great things for not only Bitcoin, but the whole economy in aggregate. So you're probably still a little bit confused after all of this on what is actually going on with the supplementary leverage ratio and Basel III and its relationship to Bitcoin. And rightfully so. This is a very complex topic that a lot of people in the space, traditional economics and investing, a lot of them are even struggling to understand this. So it's very complex, but as long as you understand the basics of the concept, you're 10 steps ahead of everyone else. And it's definitely something that you can keep an eye on going forward. Because if you do see news regarding this, you'll know exactly what it means and you'll remember this chart. So I hope you guys found this valuable. Like the video to help support the channel. Comment below to let us know what you think about all this. And subscribe with the bell icon to get notifications when we post content like this. All right, everyone. As always, stay one move ahead. Have a great weekend.